Welcome to another exciting edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal, and look, we are today doing a deep dive. We are digging all the way in to what's going on with the U.S. economy, looking at those recession fears that have really started to crawl back out from some of those economic reports. Some economists, some asset managers have really started to talk about that R word again. So we want to talk about the latest, biggest piece of data that we have, and that is the Fed's Beige book. We're going to talk about what that is and all that. We're going to get into what the Beige book is and what it tells us about the economy. We're going to talk about what's different about this latest Beige book. It just came out at 2 o'clock today. Markets had their little reaction. We're going to talk through all of that. We're also going to talk about what it's telling the Fed about the economy. This is the Fed's Beige book. They put this out. They read this. This is big for Fed Chair Jerome Powell and the entire FOMC in terms of what they're going to do on rates and on policy, and in terms of how they're talking to the country about what's going on with the economy. So we're going to tell you what this is telling the Fed. We're going to talk about how that story aligns with the data we've got involved. We got some charts I'm going to show you guys in just a second. And of course, we're going to talk about how it could affect the upcoming September 20th Fed decision and Fed policy for the rest of the year. So let's get into it. Let's first talk about what the Beige book is, right? Because this isn't something that I think folks talk a lot about. It's not one of those big headline reports, but it's very important, especially right now when you've got folks talking about, oh, is there going to be a recession? Oh, are we headed towards some bad economic times? Well, let's look at the data. Let's look at the Beige book. So for those of you who aren't familiar, the Fed's Beige book is the review of the economy. It's officially known as the summary of commentary on current economic conditions, which is why folks just call it the Beige book, because it is beige. And it looks at economic conditions from all 12 regional banks of the Federal Reserve. So going out from New York, Philadelphia, to Kansas City, Atlanta, San Francisco, Minneapolis, there are 12 banks, there are 12 Federal Reserve regional banks. They're located all throughout the country, and each one of those districts or regional banks reports on what's going on in their area. And that's what we hear. We get these reports from all across the US, and they say, hey, business owners, hey, labor leaders, hey, folks who are really in touch with the consumer, what's going on? Tell us what you're seeing. And they compile those all into one big report and put together in this very quick, little, easy to read kind of book that tells you, here's what's going on. If you're interested in diving into what's going on in the San Francisco region, which is all of California, all the way up there to Washington and Oregon, and actually getting over to Nevada, if you're interested in the New York region or the Richmond region, or if you're just interested in what's happening throughout the nation, the Fed's Beige book is it. So let's talk about really quickly what the Fed's September Beige book found. And they put these out before every month when they're going to have a meeting. They'll put it out a couple weeks before, just give folks an idea of what they're looking at and what they're thinking about. So this Beige book looked at July and August number, and the two biggest headlines I found from reading this report were, number one, quote, job growth was subdued across the nation. Job growth subdued. If you've been watching Market Takes when we do jobs reports on the first Friday of the month, you know that subdued is not really the word that we've been using to describe the jobs report for most of this year, right? Jobs have been booming for a while. It's certainly slowed down, but the idea that job growth was subdued across the nation, that really jumped off the page at me. The second big headline was, quote, most districts reported price growth slowed overall, decelerating faster in manufacturing and consumer goods sectors. That's, I think, big too as well. Again, this is what the Fed wants. The Fed wants to see price growth slowing, right? The Fed wants to see deceleration of those things, particularly manufacturing and consumer goods sectors, but that's been happening already. So we're seeing that even more, and that could put even more of a drag on inflation, bringing inflation back down even further. Keep in mind, and keep those in mind, those two big headlines. Remember, job growth subdued across the nation and price growth slowing, especially in those manufacturing and consumer goods sectors. We got a couple of charts we're going to show you here in a few minutes. Now, the July Beige book also found labor demand continuing. And so going back to July, let me just make sure and separate those two. July's Beige book, which was the previous Fed meeting that we had, that found that labor demand continued, strong labor demand continued, and strong demand for housing with cooling inflation. Some businesses were reticent to raise prices as consumers slowed their spending. So that's what was happening in May and June of this year. As we get to this month, we hear job growth subdued across the nation. Most districts reported growth slowed overall. Price growth, slowed overall. That shows you that those trends are continuing and maybe strengthening more. Those trends that we saw from the July Beige book actually getting stronger. A quick note on prices, I want to read you a quote, contacts in several districts indicated input price growth slowed less than selling prices as businesses struggled to pass around cost pressures. As a result, profit margins reportedly fell in several districts. That's a lot of blah, blah, blah. Here's what that means. What that means is we're seeing for a long time, really going back through 2021, as this inflation picked up and really started to move higher, we saw companies very able to pass along those price pressures to consumers. When folks, when your favorite brand at the grocery store raised the price, a lot of people were just saying, hey, you know what, prices are higher, inflation's crazy, I just got to pay this. What we're seeing now, according to the Beige book, is that companies are finding it less easy to do that. They're seeing their prices and what they're paying for the things that they need to make their products, or the things that they need to use to put into their products. That includes labor, that includes raw materials, all those things. Those prices aren't coming down that fast, but the price that they're able to pass on to consumers are pushing back a little bit. They're not buying the way they used to, and they're having some trouble selling. And also those margins, as in how much money the business makes for everything they sell, those are contracting a little bit, and there is pressure now on those margins. So that's certainly interesting from the report. Another thing that really caught my eye was, quote, consumer spending on tourism was stronger than expected, surging during what most contacts considered, and this was the part that really jumped off the page for me, the last stage of pent-up demand for leisure travel from the pandemic era. So what we're seeing and what we're hearing now, or what these folks are hearing when they talk to their sources, when they go out and talk to business owners, they're hearing that this is the last stage of pent-up demand for leisure travel from the pandemic era. Tourism was strong, that's good, but it's surging during the last stage of pent-up demand. Well, this pent-up demand has really been boosting the economy and really holding the economy up. And if we're entering that last stage, well, we've already seen airline fares declining in the CPI report, right? That CPI inflation report, we've seen a big drop last couple months in airline fares. Though I will tell you, as someone who's taken airlines the last couple months, I haven't seen that myself. But anyway, that's what the data tells us. But could this demand drop that we're seeing and this drop off from the end of, or the last stage of pent-up demand or pent-up leisure travel demand start to mean that hotels get hit, that hospitality, that leisure and travel, these have all been the things that have led jobs growth higher. And this is what's really been pushing up and holding up the economy. If we're getting to the last stage of that, where does that start to play out? That's a really interesting thing to watch out for, and that was big in this report. Another thing to watch out for, many contacts suggest the second half of the year will be different. What does that mean? Different how? Let me read you the rest. Growth in labor cost pressures was elevated in most districts, often exceeding expectations during the first half of the year. But nearly all districts indicated businesses renewed their previously unfulfilled expectations that wage growth will slow broadly in the near term. What's that mean? It means lower raises. It means companies not paying as much to bring on new employees. It means that wage growth that we had seen that was picking up, that was pushing those lower income folks' salaries higher, that was offsetting this high inflation that we'd seen, that was really keeping folks able to keep spending that money. We're seeing that going away as business owners expected. So we really haven't even needed to see that recession. A lot of folks were thinking that would bring down those wage pressures, or that would bring down the ability of folks to demand higher wages. We haven't seen that recession, but what we are seeing from the data, or what the Fed's Beige book is saying, businesses are saying, is that you're already seeing the push down on wage pressures, and folks aren't able to negotiate or able to get more money in negotiations for their salary, in negotiations for raises, in negotiations for new jobs. Expecting that wage growth will slow broadly in the near term. That, I think, tells you a lot about the economy. And this, I think, this Beige book is telling us a lot about what's going on in the economy. What we always do here on Market Takes, we gotta check in on the market. So I wanna throw up here on your screen and give you a look at what we're seeing in the markets right now. Now, what we've got up there is the bond market. And I wanted to highlight this because this is the 10-year note. This is the most traded note in the market. Look at this pickup we've seen really over the last week, right? It's just basically a straight line up, moving up, and we are getting back towards those highs. These are 15-year highs that we saw here back at the end of August or mid-August, and there was a big deal about that. We're moving right back towards that again. What that's also doing is pushing up the dollar index. So the value of the dollar, as you're seeing right here, it's just going straight up. Really, from that low that we saw in mid-July, we have continued to move higher and higher, and the value of the dollar is strengthening. That's good for US inflation, but that's going to kind of push out those pressures onto other countries, and it's going to make things more more expensive. Really what this does when the dollar strengthens is it weighs on companies, and we have seen US companies kind of sounding the alarm a little bit already. Let's take a look at the stock market really fast. When you look at the S&P 500, one thing, this is a year-to-date chart. I want to point out just what's happening right here, right? We tried to move higher, and you saw the market rising higher coming off the last couple weeks, but now we're moving lower. Let's take a look at what's been happening over the past 3 months. You can see it very clearly there, right? The market moving down. And this really what we're seeing is just illustrating the kind of challenges that the market has had and the challenges that we have seen in the market across those asset prices as yields have gone up on bonds. That's with inflation expectations picking up, with expectations for growth. Well, that might be going away. That's definitely pushing against what we're seeing or what we're hearing in the Beige book report. Now, what is this report telling the Fed, the Federal Reserve, about the economy? Well, are things changing? Yes, it seems like certainly right now those wage pressures are coming down. We're seeing those price pressures start to come down. We are seeing a lot of the things that were big themes of last year and the first half of this year really starting to undo themselves. And now the worry is, are we headed towards this recession? Are things starting to get so bad that actually economic growth could reduce and go to the negative side? And that's the big question as we move into the third and the fourth quarter of this year. Really, no one's talking about right now a recession for 2023 because we've already made it through the first 2 quarters of the year, gotten data that shows positive growth, expectations for positive growth in the third quarter as well. But the big question is what happens the rest of this year and into next year. And we are seeing some signs that labor markets are losing a lot of strength. Again, the big headline that we pulled out from this report was, let me go back and find that, job growth was subdued across the nation, right? That's definitely different than what we were hearing at the beginning of the year, certainly different than what we were hearing at this time last year. But the Fed right now is seeing this happen. They want inflation to come down. They want growth to slow down, but they don't want it to do that too much. So they're walking a bit of a tightrope, and they're going to have to continue to walk that tightrope, continue to talk the talk about getting inflation back to 2%, but they don't want to destroy the labor market so that we're not only seeing lower numbers, but seeing negative numbers. Speaking of the numbers, let's start and get some charts up here on your screen so I can show you just what we're talking about. Remember, one of the things that we found in this report was this headline that most districts saw reported price growth slowed overall, decelerating faster in manufacturing and consumer goods sectors. So I want to put a chart up here on your screen that's showing you what's going on in manufacturing. This is across the globe around the world. We know that the US doesn't do a lot of business in terms of what it's exporting to the rest of the world and doing manufacturing. It's a smaller part of our economy, but so goes the world, so goes the US. You really can't have the US just outperforming, doing great while the rest of the world is slowing down. We are seeing a clear slowdown there from the global manufacturing PMI. That 50 number that's going across your screen there, when it's below 50, that means things are contracting. That means the economy is getting worse. That means manufacturing is slowing down. Companies are making less money, doing worse. We have been pretty firmly below that for a good portion of this year, and we haven't been able to get back up over 50, which is what signals expansion, growth. Companies are doing well, they're doing better. And like I said, this chart just illustrates the change that we're seeing, and it's not a change where things are getting better, it's a change where things are slowing down. I want to put another chart up here on your screen, and that's the jobs data. So again, remember, jobs growth has been subdued. Well, you're seeing as the last 3 months, job growth is the lowest we've seen going all the way back to 2021. Now, as you see up there on your screen on the right side, we've been going increasing number of jobs each month. But also remember, if you were watching Market Takes, I told you we have seen negative revisions for every single month of the year this year. So it's likely, given the trend, that we could see those numbers go even lower than what we've seen over the last few months, and maybe even get under 100,000 jobs added per month. That's falling below just the rate that you need to maintain the economy, to keep things moving. You need about 100,000 or a little over 100,000 jobs added each month just to keep pace with the number of new entrants, people turning 16 or 18, getting jobs, you know, the births, all that good stuff that's allowing people to move into the labor market. You got to add about 100,000 jobs. We could start moving below that, and maybe we start to see some negative jobs growth or negative jobs on this jobs report. That's one thing the Fed is definitely going to be worried about and looking at, and perhaps some alarm bells start to go off in the markets if we see that. But this chart, again, just illustrating the deceleration we've seen in wages, or I'm sorry, in jobs growth over the past year. Last chart I want to put up there is an inflation chart showing CPI and PCE inflation. And what you see there, CPI, the consumer price index, that's much more followed, more popular measure of inflation. That's the blue line. The green line is the Fed's favored measure of inflation, PCE, personal consumption expenditures. We saw CPI above PCE for most of the year, and that was just important because the Fed really didn't watch CPI as much. PCE was lower, and so the Fed could say, okay, well, things are high, we've got to keep doing what we're doing, but things aren't up at 8-9% where they were on CPI. Well, now PCE is actually above CPI just by a little bit, and we are moving away from the Fed's 2% target. For most of this year and going back to last year, we're moving towards that 2% target, moving lower. And what we have seen is that CPI inflation has started to pick back up, and PCE inflation has picked back up, and they are both rising rather than falling last month. So we will get new reports on those in September, but right now we are seeing a pickup in inflation, and really there's an expectation for that to continue. Given what we've heard in the Beige book, that might be difficult. So that's a good news thing. You want inflation to come down because then the Fed doesn't need to raise rates as much. They don't need to tighten the economy as much. Folks can go out and get those loans and things like that. But we'll see when we get those reports later on. And this chart is just illustrating the movement we have seen over PCE, CPI inflation overall. Listen, last thing before I want to get out of here is how could this affect the Fed's meeting? Well, we have seen the big question coming into this month is, will the Fed project another rate increase? And this report doesn't suggest they will. It suggests that rates are high, that they're doing the job, they're bringing down inflation, they're starting to weigh on the labor market, and folks aren't having as many good opportunities out there to get jobs. For you and I, that's not a good sign. We don't want that. We want the economy to be robust. We want job gains. We want all that. But that pushes up inflation, and the Fed does not want that. So this is right now, markets are predicting the Fed will not raise rates again, but that they will say that they plan to raise rates again. We'll see how that works out. This Beige book doesn't tell us the Fed's going to likely say, hey, we want more. We think there will be a need to raise rates again this year. And that's probably market positive based on what we've seen. It might not be economy positive though. And that's kind of where we are right now. So listen, the Fed meets on September 20th. We will be right here on Market Takes. But before that, we will have the CPI report on July 13th. We'll be right here at 10 a.m. Eastern time, giving you all the information that you need on Market Takes. And listen, that's going to do it for our episode here, our latest episode. I am Dion Rabouin, reporter for the Wall Street Journal. We will see you next time.